Welcome to my channel Wealth Creation. Today we are going to see about equity mutual funds. Now let's see what is equity funds. Equity funds are the funds which invest in shares of different companies. It generate better return than FD or debt funds. It provides a high risk as its performance is based on the market conditions. Fund managers always try to offer great return by investing in different companies from different sectors or with different market capitalization. Now let's see the advantage and disadvantage of equity mutual funds. It is highly diversified and provides high liquidity. It is professionally managed by a fund manager, and we can start investing even with small amount like 100 rupees, and we can avail the systematic investment plan. Tax benefit is also there, and it provides an exceptional past returns. Disadvantages are uh, it is not for short term. You need to invest for a long time, like 7 to 10 years. You need to stay invested in equity funds. There is no control because its return or performance is based on the market condition, and higher cost, which means the expense ratio will be high. It is based on the type of equity fund which you select, and choice overload is there. Which means if you invest in two or three equity funds, there is a possibility that same the two funds will be investing in same company, where there will be a overload will happen. Now let's see the types of equity funds. Index funds, its investment strategy is based on the market indexes, like it will be a replica of index like Nifty 50 or Nifty Next 50, Sensex. Whatever the companies the Nifty 50 is invested, this index funds will invest in the same companies at the same percentage, and its investment period is 8 to 10 years, and it is moderate risk. Next is thematic or sectoral funds. It is based on a sector or a theme. For example, bank based funds are there, pharma funds are there. Likewise, it is based on a particular sector like pharma, IT, or FMCG sector, like that. These kinds of funds will invest only based on a particular sector, so the risk will be higher, and you need to stay invested for 5 to 7 years at least, so that you get a better return. Then is focus funds. They will invest only in 30 focused companies. It is restricted for only 30 companies. They won't invest more than 30 companies, and its investment period is 5 years, and it is high risk. Next is large and mid cap funds. It will invest in largest 250 companies, and its investment period is 5 to 7 years. It is slightly more riskier than the large cap because we are investing in both large cap and mid cap, so it is slightly higher risk. Next is large cap. It will invest in top 100 large cap companies, and its investment period is 7 to 9 years. If you are planning to invest for 7 to 9 years, then you can go for large cap funds, and its risk is moderate. Next is mid cap funds. It will invest in next top 150 large cap companies, and the investment period is 5 to 7 years. It is little riskier. Next is multi cap funds. It will invest in large cap, mid cap, and small cap companies. Now, SEBI has given a new rule that multi cap funds should invest equally in all the funds. So, in each category, it will be investing 25%. There should be a 25% of investment, and the process is going on. So, its investment period is 5 to 7 years. It is also a little riskier. Next is small cap funds. It will invest in 250 small cap companies. It can invest any of 250 small cap companies. In that, it can invest in any small cap companies. So it is highly risky because we can't predict that which small company will hit and which will flop. So it is high risk, and the investment period is 5 to 7 years. Next is Contra equity funds. This kind of funds will invest based on the contrarian investing strategy, and its investment period is 5 years. It have higher risk. Next is value funds. It will invest based on value investing strategy. Its investment period is 5 years. It is also high risk, having high risk. Now let's see the taxation of equity funds. If you hold the units of equity fund for 1 year, then it is it will be, and after 1 year, if you are redeeming or exit from the fund, 15% of tax will be collected irrespective of your tax slab rate. If you are holding the units of a equity fund more than 1 year, then long term capital gain is taxed. If it is more than 1 lakh, 10% of tax will be collected without indexation benefits. Thank you for watching this video. I'll be meeting you with another interesting video tomorrow. Until then, it's Shamla signing off. Bye.